Our guest tonight is also bullish on Twitter. Kevin Landis already owns shares of Twitter. It's through a closed-end venture capital fund. He's founder and chief investment officer at First Hand Capital Management. Kevin, nice to have you on the program. We know, as we said, that you already own the stock, but for people who don't, we know what hype does to a stock. We saw that with Facebook. So if somebody wants to own Twitter, do you think that they should get it right on the day of the open, or wait a little bit until it's been around for a while?
Well, I guess for any investment, it depends a great deal on the price. So it's a quality company, and it's likely to be, in our view, it's an emerging blue chip and a great growth story. But there is no investment, no matter how wonderful, that can't be overpriced. So you really have to take a look at the numbers once they're out, run the numbers, and see what you're paying for that.
You know, Kevin, one thing that I think of when I think of initial public offerings is that the people who are selling their stock, they all make money. The investment bankers make money. But whether you, the individual investor, will make money or not is kind of anybody's guess. As a general proposition, do you think it's wise for people to go into IPOs or buy, because it's very hard to get those IPOs, to buy immediately after on the open market?
Well, you're looking at somebody, or you're talking to someone who did not buy Google on the IPO and has regretted it ever since, right? That would have been a great investment. So there are some cases when you absolutely should. I guess the thing to look at is the IPO day is the first of many days that stock will be publicly tradable. And so while there's no reason that you can't buy it that day, there's no reason you can't buy it the day after as well.
What about other social media stocks? You heard Asima's report. Some of them have really taken off since their IPO, whether you look at LinkedIn, Yelp, even Facebook. Is it time to take profits in these stocks, or is there still more to be made?
Well, you know, if you look out at the tech landscape, it's really sort of a tale of two groups of stocks. The old guard has been around for so long that they really struggle to show any growth at all. I'm talking about Oracle or Intel or Cisco. And they trade like it, and they don't have a lot of upside to them. So the few growth stocks that are out there, and it is very few because it's so hard to go public ever since Dodd-Frank, the people will pay really high multiples when they see growth. So if you look at Salesforce.com, or if you look at LinkedIn, or you look at any of these others, they're really expensive. And there's kind of this gulf in between where reasonable growth plays just aren't that common.
You own some of the shares through a venture capital fund. What do we really know about how much money Twitter makes and whether they are growing their profits at a nice pace? What do we know?
We don't know much, and that makes it much tougher. And that's frankly why the venture capital investing game is so much tougher. You have much more limited information, and everything is a chore. The research is much more of a chore. Just getting your hands on shares is much more of a chore. But you know, that's what makes that game much more rewarding, I suppose.
All right, lots of good information. Thanks a lot, Kevin. Have a great weekend. Kevin Landis, Chief Investment Officer at First Hand Capital Management.